Riding the Waves of Market Psychology. An Introduction to Elliott Wave Theory. Imagine yourself standing on a beach, watching the waves roll in and out. The waves are mesmerizing, aren't they? They come in sets, some larger, some smaller, but always in a pattern. You notice a pattern, a series of larger waves followed by smaller, receding ones. This isn't just a random occurrence, there's a rhythm to it. This rhythmic ebb and flow is not random. It's a natural phenomenon that can be observed in many aspects of life. It's governed by powerful, underlying forces. Just like the ocean waves, the stock market is influenced by similar forces. The stock market, like the ocean, also exhibits patterns of movement driven by a powerful force, human psychology. These patterns can be seen in the way prices rise and fall over time. Elliott Wave Theory, developed by Ralph Nelson Elliott in the 1930s, provides a framework for understanding and predicting these market movements. Elliott observed that market prices unfold in specific patterns, which he called waves. It posits that market prices move in repetitive cycles, driven by investor sentiment, which alternates between periods of optimism and pessimism. These cycles are not just random fluctuations, they follow a predictable pattern. By learning to recognize these patterns, traders and investors can gain a significant edge in the market. Understanding these cycles allows them to anticipate market movements and make more informed decisions. Elliott Wave Theory is not a crystal ball. It doesn't guarantee success or predict the future with absolute certainty. Instead, it offers a probabilistic approach to understanding market trends. Instead, it provides a powerful tool for analyzing market sentiment, identifying potential turning points, and managing risk. By understanding the waves, traders can better navigate the market's ups and downs. By understanding the basic principles of this theory, you can make more informed trading decisions and potentially improve your investment returns. The key is to study the patterns, understand the psychology behind them, and apply this knowledge to your trading strategy. With practice and experience, Elliott Wave Theory can become an invaluable part of your trading toolkit. Decoding the market's DNA. The basics of Elliott Wave Theory. At its core, Elliott Wave Theory is based on the idea that market prices move in a 5-wave pattern for the primary trend and a 3-wave pattern for corrections against the trend. These wave patterns are labeled with numbers for impulse waves and letters for corrective waves. These patterns repeat themselves on all time frames, from minutes to decades, reflecting the fractal nature of market movements. Understanding these basic wave structures is the first step towards mastering Elliott Wave Theory. Let's delve deeper into each wave type. Riding the wave of optimism. Understanding impulse waves. In the world of technical analysis, impulse waves are a fundamental concept that traders and analysts rely on to predict market movements and trends. These waves are part of the Elliott Wave Theory, which was developed by Ralph Nelson Elliott in the 1930s. Understanding these waves can provide valuable insights into market behavior and help traders make informed decisions. An impulse wave is a 5-wave pattern labeled 1, 2, 3, 4, and 5. That moves in the direction of the main trend. This pattern is essential for identifying the primary direction of the market. Each wave within this pattern has its own unique characteristics and significance, contributing to the overall structure of the trend. Each wave within this pattern has its own characteristics and significance. Understanding these individual waves can help traders anticipate future market movements and make strategic decisions. Let's delve deeper into each of these waves to understand their roles and implications. Wave 1. This wave marks the beginning of a new trend. It is often fueled by a shift in market sentiment or a change in fundamentals. This initial wave sets the stage for the subsequent waves and is crucial for establishing the direction of the trend. It is often fueled by a shift in market sentiment or a change in fundamentals. Traders and investors may start to notice new opportunities or changes in the economic landscape that prompt them to take action. As a result, volume often picks up as prices rise, indicating increased participation and interest in the market. Volume often picks up as prices rise. This increase in trading activity is a sign that more participants are entering the market, driven by the new trend. The rising volume confirms the strength of Wave 1 and sets the foundation for the next wave. Wave 2. This wave represents a correction against the trend established by Wave 1. It is typically characterized by profit-taking by early buyers and a temporary return of pessimism. This corrective phase is a natural part of the market cycle and provides an opportunity for the trend to consolidate before continuing. It's typically characterized by profit-taking by early buyers and a temporary return of pessimism. During this phase, some traders may decide to lock in their gains, leading to a pullback in prices. However, this retracement is usually limited and does not negate the overall trend. Wave 2 usually retraces a portion of Wave 1's advance. This retracement can vary in depth, but it generally does not exceed the starting point of Wave 1. The limited retracement indicates that the market is still in a bullish phase, and the trend is likely to resume. Wave 3. This is typically the strongest and longest wave in an impulse sequence. It reflects growing confidence in the new trend. As the market gains momentum, more participants join in, driving prices higher and extending the trend. It reflects growing confidence in the new trend. This wave is often marked by significant price increases and high trading volume. The strong performance of Wave 3 reinforces the trend and attracts even more participants, further fueling the market's upward movement. Wave 3 often extends beyond the end of Wave 1, accompanied by high trading volume. This extension confirms the strength of the trend and signals that the market is in a robust bullish phase. The high volume during this wave is a testament to the widespread confidence and participation in the market. Wave 4. This wave is another corrective phase, usually shallower than Wave 2. It represents a period of consolidation before the final push higher. This phase allows the market to catch its breath and prepare for the final wave of the impulse sequence. It represents a period of consolidation before the final push higher. During this phase, the market may experience sideways movement or a slight pullback. However, the overall trend remains intact, and the market is poised for the final wave. Wave 5. This is the final wave in the impulse sequence. It represents a final burst of optimism before the trend reverses. This wave is often driven by the last surge of buying interest as traders and investors try to capitalize on the remaining trend. It represents a final burst of optimism before the trend reverses. As the market reaches its peak, the enthusiasm starts to wane, and the trend begins to lose momentum. This final wave is a critical point for traders to recognize potential reversals and adjust their strategies accordingly. Volume often declines in Wave 5 compared to Wave 3. The decreasing volume indicates that the trend is losing strength, and a reversal may be imminent. Recognizing this pattern can help traders anticipate changes in the market and make informed decisions to protect their investments. The power of 3 identifying corrective waves. Understanding these patterns is essential for any trader looking to navigate the complexities of the market. Corrective waves, labeled A, B, and C, move against the main trend. They serve as a counterbalance to the dominant trend, providing a necessary pause or retracement. They are typically more complex and challenging to identify than impulse waves. This complexity arises from their varied structures and the way they interact with the overall market sentiment. Here's a breakdown of the 3 main types of corrective waves: zigzag, flat, and triangle. Each type has its own unique characteristics and implications for future price movements. Zigzag, 535. This is the most common type of correction. It is straightforward yet powerful in its implications. It consists of 3 distinct waves: a 5-wave decline, Wave A, followed by a 3-wave bounce, Wave B, and another 5-wave decline, Wave C. This pattern often signals a strong correction within a larger trend. Flat, 335. This correction consists of 3 waves with a more sideways structure. Unlike the zigzag, the flat correction tends to move horizontally, indicating a period of consolidation. Wave A is a 3-wave movement, followed by a 3-wave countertrend move, Wave B, and finally, another 5-wave impulse in the direction of the main trend, Wave C. This pattern often suggests a temporary pause before the trend continues. Triangle, 33333. This corrective pattern is characterized by 5 overlapping 3-wave movements. Triangles are unique in their ability to compress price action into a tighter range. Triangles typically indicate a period of consolidation before the main trend resumes. They often appear before significant market moves, acting as a precursor to a breakout. Identifying corrective patterns is crucial for traders because it allows them to anticipate the resumption of the main trend and capitalize on trading opportunities. By recognizing these patterns, traders can better manage their positions and make informed decisions, ultimately enhancing their trading strategies and outcomes. Surfing the market's tides, wave degrees, and market cycles. Elliott wave patterns are fractal, meaning they appear on all time frames. A 5-wave impulse pattern on a daily chart could be part of a larger 5-wave pattern on a weekly chart, which itself could be part of an even larger pattern on a monthly chart. This concept is known as wave degrees. Understanding wave degrees is essential for identifying the larger context of market movements. For instance, a corrective wave on a daily chart might offer a buying opportunity within an ongoing uptrend on a weekly chart. By applying Elliott Wave Theory across different time frames, traders can gain a comprehensive view of market cycles and make more informed trading decisions. The golden ratio of market harmony, Fibonacci and Elliott Wave Theory. Fibonacci ratios, a mathematical sequence where each number is the sum of the 2 preceding ones, like 1, 1, 2, 3, 5, 8, play a crucial role in Elliott wave analysis. These ratios, particularly 0.618, the golden ratio, and its inverse 1.618, frequently appear in price and time relationships between different waves. Traders use Fibonacci retracement levels derived from these ratios to identify potential support and resistance levels within Elliott wave patterns. For example, after a significant price move, traders often look for a retracement to the 0.618 or 0.500 level of the previous wave. Fibonacci extensions are also used to project potential price targets for impulse waves. By combining Elliott wave patterns with Fibonacci ratios, traders can enhance their ability to identify high-probability trading setups.